Hello financial fans, welcome back to another stock analysis. Today we'll be covering Starbucks stock ticker SBUX. Starbucks is a globally recognized multinational coffee house chain that operates thousands of locations worldwide. With a focus on delivering high quality coffee and beverages, Starbucks offers an extensive menu that includes a wide range of hot and cold drinks, such as espresso, lattes, cappuccino, teas, and signature frappuccinos. Beyond beverages, Starbucks also provides an assortment of delicious pastries, sandwiches, salads, and snacks to complement their drink offerings. They take pride in sourcing ethically grown coffee beans and promoting sustainable practices throughout their supply chain. What sets Starbucks apart is their dedication to creating a unique and inviting atmosphere for customers. Their stores are designed to be more comfortable and welcoming spaces where individuals can relax, meet friends, or work. Whether it's studying, conducting business meetings, or simply enjoying a cup of coffee, Starbucks aims to provide a positive and community-oriented experience for its patrons. The company is currently sitting at a market cap of $111.5 billion, and in 2022 they generated a revenue of $32 billion, and is sitting at currently a dividend yield of 2.17%. 61% of their revenue is generated through their beverages, 18% from food, and the remaining 21% from other various income streams. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using the scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first 2 metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $2.2 billion in 2013 to $4.4 billion in 2022. The average EBIT growth during these years on average has been sitting at 21.4%, which is a 10% deduction in the margin of safety. The margin has gone down over the years, going from 14.8% in 2013 to almost 14% in 2022. However, there is still a margin growth in our calculation, since in 2022 their margin was very low due to, of course, the lockdowns, and they were managing to climb themselves out of this, which still gives them a margin growth of 7.8%, which is a 5% deduction for a margin of safety once again. The next 2 ratios are the dividend growth and the payout ratio. The dividends are looking very nice. They went from 42 cents in 2013 to $2.12 a share in 2023. This is an annual dividend growth on average of 17.8%, which is a 10% deduction from a margin of safety. This with a payout ratio that is sitting at a solid 66%. Which is no change in the margin of safety on this metric. The final 2 metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Starbucks, this is relatively high, sitting at just under 3.5 years, in this case a 345% debt to EBITDA ratio. We like to see this under 300% usually. But this awards them then with a 5% increase in the margin of safety. The return on invested capital for Starbucks is sitting at a very solid 14%, indicating that the management is very effective at allocating capital, which is a 5% deduction in the margin of safety. Looking very good so far for Starbucks. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model we'll be using is the discounted cash flow model. I've imported the free cash flow of Starbucks going from 2015 to 2022. The average growth rate in their free cash flow annually during this period was 562%, but this is mainly because their free cash flow is very inconsistent, and since in COVID they had a very low free cash flow number, making it obvious that it increases a lot the year after. I'm projecting an expected growth rate in their future free cash flow of 8% for the next 10 years, and with this percentage we'll determine the future free cash flow for Starbucks and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives them a sum of free cash flow of $46.8 billion, and to get our equity value we have to add the cash and equivalents and subtract the debt, leaving us with a equity value of $44.1 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of only $38.42, which is a 60.5% downside. This is mainly due to the big decline in their free cash flow going into 2022. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Starbucks coming from 4 years ago to the current year, and on average their dividends have grown by 10.17%. And I'm projecting that all of their future dividends will grow by around 7%, and we'll once again use a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $151.23, which is a 55.41% upside out of this model. The next model that we'll be looking at is the Graham's revised valuation formula. In this model, we take a look at the earnings per share that Starbucks is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth shouldn't be exceeding 7. Looking at all of these metrics then, we get a fair value of $71.76, which is a 26.25% downside of this model. The fourth model that we'll be looking at is the multiple valuation. In this model, we take a look at similar companies to Starbucks, look at their stock price and their earnings per share. In this case, we can then determine the average P multiple in the industry, which is sitting at 27.56. All that's left to do to get a fair value out of this model then is to multiply by the earnings per share that Starbucks is generating, which is $3.08 a share, giving us a fair value of $84.90, which is a 12.76% downside of this model. And the last model that we'll be looking at is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this is the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 1.84%, while the current dividend yield is sitting at 2.15%, indicating that it's undervalued on this metric. Doing the same with the PE ratio, on average for the past 5 years it has been sitting at 24.9, while the current PE ratio is higher, sitting at 31.59, indicating that it's overvalued on this metric, giving us a fair value of $95.07, which is a 2.3% downside from the current price. If you want to get access to all of the models that I use in my videos and much more, you can check the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at the final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $88.28. A margin of safety we've determined earlier using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, and deducting it by 10% for the EBIT growth and the dividend growth, and 5% for the margin growth and the return on invested capital, leaving us with no margin of safety at all, indicating that the fair value is the same as the average out of all of our models. And then with the current price of $97.31, we get a small downside of 9.28%, indicating that's a slight sell right now. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.